Welcome back. I'm Charles Lewis, the Austin area realtor who brings you topics and discussions that will help you make better decisions when you buy, sell, or invest in real estate. Today, I'm with my friend, Chad Christian from Security National Mortgage. Chad, thank you so much for coming back and visiting us again today.
Oh yeah, it's great to be back.
Today, I'd like to talk about a underutilized option when it comes to buying a home. Now, we all know that interest rates have gone up significantly. I mean, we talked about that in one of our previous videos, right? Like doubled in less than a year. But what if you were able to get last year's interest rate on your current loan? Is something like that even possible, Chad?
Yeah, it is.
How could somebody possibly do something like that?
Well, there's a certain program out there that not a lot of people have known about, Assumable Loans.
Assumable. Okay, Now to be clear, we're not talking about a purchase subject to the existing mortgage where the seller stays on the loan. We're talking about assuming that loan, right?
Yeah.
So that the buyer would actually go on the existing loan and they would be able to retain all the terms of that loan, right? Including the interest rate.
Yeah, so to give you an example, let's say that the seller owed $250.
Okay.
And they wanted to sell the house for $350.
Okay.
Based off of what the market value is.
Okay.
So you're the buyer.
Okay.
And you have the means to be able to put the money down necessary to meet the current loan amount.
Because you'd have to cover that difference.
You'd have to cover that difference, yeah. And let's say that the seller had a COVID interest rate.
Right.
Sub twos.
Right.
And you met the criteria, DTI, credit, those type of things.
Now, for those out there, DTI is?
Debt to income.
Thank you. Okay.
Yeah, which is a big factor.
Right.
Now, the big thing to it is it has to be a government loan.
Okay.
FHA, USDA, VA.
Okay, so if the seller has one of these government loans,
Yep.
and the buyer is able to qualify for that loan,
Yep.
what if I'm not a veteran and it's a VA loan?
Yeah, even with VA loans, you don't have to be a veteran.
You just need to be able to qualify.
You just have to qualify for their ratios and the certain requirements that they want.
Gotcha. Interesting. All right, so walk us through that. How would that work? I mean, that doesn't involve an approval through someone like yourself, right?
No, so it all depends on the servicer. So whoever is carrying the note at that time, and if it's available. The way the market is going, these lower interest rate loans, they're not really subject to being refinanced. So the servicer would like to see those loans through because their whole thing is collecting the interest on the loan. So there's going to be probably a lot of servicers out there that are willing to do it.
Okay.
Because a lot of them are carrying those notes because they know that at their current interest rate, they're most likely not in a position to have to refinance because they've already done it.
So in other words, is that who's ever holding the loan, that servicer, even though they would make more money if they were able to get a loan financed at the higher rate,
Right.
their concern would be that that current borrower is never going to refinance that thing because it's so low.
Right.
But they would be able to retain that loan if somebody else was able to purchase the house.
Exactly.
Gotcha.
So they, get all the benefits of that, and they don't have to worry about the loan coming to term.
Well, it certainly sounds like something that would be very attractive to someone who is trying to purchase the market because remember, in an ideal scenario, the list price of the house is probably been reduced because of the higher interest rates.
Yeah.
I mean, it's not directly related to it, but because buyer demand has gone down so much, many sellers are reducing the list price to make it more attractive. But if you were able to get that reduced list price plus assume the existing loan, that would be a fantastic win.
Well, and it's a lot of benefit to the buyer just as much as the seller. So they get the lower interest rate, especially given the times that we're in right now.
Right.
And not only that, depending on where they're at in the term of the loan, it's not like they're starting over 30 years. So, if the seller's 2-3 years into the loan, they don't have to start all over. They get to start wherever they're at moving forward.
So not only more of your payment going towards the principal, but you'd have a shorter term.
Exactly. And the seller, after they assume the loan is no longer liable.
Exactly, because again, that's the distinction. It's not a subject to.
Yep.
Is that they've actually put the buyer on the loan, so it's now their loan.
Yep.
That seller, it's no longer on their credit report, so they're able to purchase another home if they so desire or whatever. So I guess probably the biggest obstacle is depending upon what that loan balance is.
Yeah.
Someone would have to have enough cash to be able to cover that difference. So that sounds like a very interesting option. Before we wrap this up today, Chad, do you have any other thoughts or anything else that you might want to add?
No, I think we covered assumable loans, and if anybody has any questions as far as mortgage related, I'd be happy to answer them.
If you did have additional questions for either one of us, our contact information is in the video description. Also, if you have any suggestions on how we might improve these videos or topics you might want to see discussed, don't hesitate to let us know. Shoot us an email or again, put them in the comments below. So let's make your real estate dreams come true.